When we're talking to consumers, there seems to be a lot of confusion about mortgage rates, and we know that they're hearing it from the news cycle and from people they know and everyone that's not an expert talking about mortgage rates. Well, I'm not a mortgage loan officer, but I am in this industry every day. And we do hear stories every day from our preferred lenders about the things that they're able to accomplish with buyers. So, kind of the disclaimer to all of this is that your mortgage rate depends on what your credit is, what your income is, how much money you're putting down, how much money you're borrowing. So, this is a blanket statement, and your individual and specific rate that you're able to get will be up to those factors. And so, what I tell you is if you need a mortgage lender, please reach out to us. I'm happy to give you a mortgage lender, our two preferred partners. They're trusted, they're in this industry, they do an incredible job. I'm happy to give you those contacts. But the things that people are most confused about are often the rates being X amount, right? We heard this week, so this is the last week of February in 2026, and we heard this week that one of our clients got a rate with a 4 in front of it. Now, how they got that, they may have bought down the points, the seller may have bought down the points, but there are ways to get their mortgage rates down. So I wanted to take you through the history of mortgage rates, or a quick history of mortgage rates and like where we're at in the grand scheme of things, because I just think as people, we have a very narrow view of the recent past, right? And we know that rates with a 2 in front of them and even a 3 in front of them is a rare thing. And really that happens when there's a massive problem. And so, like the Great Recession or COVID, right? The last one was COVID where rates went way down. And so bad news often means lower rates. So we don't necessarily want super low rates all the time. I know it is nice, and I know that it helped with affordability as home prices were rising and continue to rise. So you look at this chart, mortgage rates annual here. You can see that the historical average from the 70s to 2023 was actually 7.72%. And there were years in the late 70s and mid 80s where rates were as high as 16%. Now, homes were a lot cheaper back then, but rates were a lot higher. The cost of money was higher. And if you look in our more recent history, from 1990 to 2023, you can see the historical average for rates was in the 6% range. So basically the predictions for this year is that they're going to be below that. This is saying 5.9%. And that is below the historical average if you take the year since 1990 to 2026. And you can still get a rate potentially in the low 5s, high 4s, maybe even mid 4s, depending on how you negotiate your contract. In Georgia, the seller can actually make a contribution to closing costs, and a buyer can use those proceeds, those funds, to actually buy down their rate to get a better rate, or the buyer can pay for it out of pocket. So there's multiple ways to get the rate down. Lenders also have programs where you can buy the rate down for 1 year, for 2 years, for 3 years, and then it'll adjust to whatever the seasonal, the rate is at that time. And so there's all kind of strategies for people to get into a good and fair interest rate. This next slide, it just shows, monthly over the last year, what rates have done. And you can see that in 2021, we were, in December of 20, we were in the 2s on average. And then we jumped up the 3 in January of 2021. And then from that's when COVID happened. From that until really it peaked in 2024, rates doubled. And also, home prices were still continue to appreciate. So for the buyers out there, they were feeling pressure on all ends, right? And then we had inflation going on. And so the reason that the real estate market has changed in the last 2 years is there's really been an affordability crunch. People just have less money because they're spending more money at the grocery store, they're spending it on home insurance, car insurance, like all the things. And so we want the appreciation to slow down, which it is, and for rates to come down, and that actually gets us back in a more affordability-driven marketplace. This was a crazy stat to me too, that over almost 50% of people have a mortgage rate of 4% or higher. I think we think that everybody's got an interest rate with a 3 in front of it. But what you can see here is there's 21% of people that actually have a rate at 6% or more. So there's actually a refinancing boom that's going on right now where people got in at 6.3 or 6.5 or maybe in 7, and they're starting to refinance, which is, just crazy. So roughly almost 50% of people are 4% or more. And like I said, when we started, we had a client get a rate with a 4% this month. So you actually have a great opportunity now to get in a very aggressive interest rate. And the thing about mortgages is that it's fixed, right? It's what I tell people about housing. The reason that you buy a house and get a mortgage is twofold. It's a great way to build your long-term wealth. Historically, housing has been the backbone of American wealth, just forever. And I think it will continue to be. And there's actually a big disparity between people that own their home and they don't, what their net worth is. So it's a great way to do that. The second reason that you do it is because you fix your living expenses, right? You fix your living expenses. So yes, you pay interest for 30 years, but in those 30 years, if you're renting, your rent is going to go up 3 to 4% on average year over year over year over year over year. So when you go and you buy something, you actually pause that cost increasing, and you pay the same thing if you were to stay in the house for 30 years. So the two main reasons for buying a house is to build wealth and to fix your living expenses every month, because the mortgage company is not going to call you and raise the rate. Can the taxes go up? Yes. Can your insurance go up? Yes. But your mortgage will never go up for 30 years as long as you're paying on time and doing all the things. And this last one is affordability. So you can see that historically since the 70s, 27% of your income went towards your mortgage. And then from early 2000s until where we are today, that number is actually 20%, and it's pulled down by the Great Recession, which went down to 17% of your mortgage because real estate got cheap, and so did interest, and so did money. And then in 2020, you can see that it went back below that 20% line again, because of a big COVID thing and nobody knew what was going to happen, just unprecedented. And so what we're seeing now is that move from the most inaffordable time, or one of them, in 2023, where it was 34% of your income to your mortgage, is moving down to 32, and we're moving back to that 27% historical average over time. And so I think all of this is good news for buyers, people wanting to re-engage in the marketplace. I think that there are many ways to get an interest rate that you feel like is aggressive, and it doesn't all have to come from your pocket. We help our clients do this all the time. And I think over the next 5 to 7 years, you're going to continue to see real estate increase in value and hopefully the rate go down. So if you're wanting to buy, or you want to know about the buying process, or you want to talk to a lender, or you want to refinance, we want to be the primary source for all of our clients to come to, and we will get them to trusted vendors that we trust and that we refer to all the time. So you get great customer service and you can trust the advice that you're getting. If we can help you in any way, please reach out, let us know, leave a comment, and like it.